Most Singaporeans invest in dividends because they want something safe, stable, and stress-free. But many don't realize this. Even the most well-intentioned dividend portfolios often contain hidden errors, quiet mistakes that slowly weaken your passive income, disrupt your cash flow, and shrink your long-term returns. In this video, we uncover the 5 biggest dividend investing errors Singaporeans make without realizing. And more importantly, how to fix each one so you can build a truly cash flow-rich portfolio that gives you confidence for the long run. So, stay with me till the end, because the last error is the one that silently affects almost every Singapore investor. Before we begin, please like this video so more Singaporeans can learn smarter income strategies. And subscribe to Wealth for You, helping you build a retirement you don't need a holiday from. Just a quick disclaimer. This video is for education and general information only. It is not financial advice, and it should not be taken as a recommendation to buy or sell any investment. Always do your own due diligence and assess what is suitable for your personal financial situation. Chapter 1. Building a dividend portfolio without a real cash flow plan. Many Singapore investors start their dividend journey with the same question: which stock should I buy? But that's the wrong place to begin. The question that actually shapes your financial future is, what income do I want this portfolio to produce for me? When that isn't asked, your portfolio grows, but in all the wrong directions. You end up with random picks from everywhere, payouts that come in waves, months of wah, so much dividends followed by months of why nothing this month, even with a $100,000 to $300,000 portfolio. The issue isn't the stocks, it's that the cash flow was never designed. Here's how to avoid this. Build an income blueprint. Before buying anything, decide how much passive income you want each year, what yield your portfolio must hit, which months you want cash to come in, and which pillars will deliver it: REITs, banks, ETFs, SSBs, telcos, infrastructure. Once you do this, your portfolio stops being random and becomes a purpose-built income engine tailored to your lifestyle and copy money goals. And here's how to fix it. Create a dividend calendar. Open a simple spreadsheet, list your holdings, mark their payout months. Suddenly, your income becomes predictable, intentional, and honestly, a lot more shiok to look at. No more guessing. No more why no dividend this month. Your portfolio finally works for you, not the other way around. Chapter 2. Chasing high yield without understanding why the yield is high. If there's one temptation almost every Singapore dividend investor has faced, it's this. 10% yield le. Confirm solid income. But here's the uncomfortable truth. A high yield doesn't always mean more income. Very often, it means more danger. When a stock or REIT is flashing a juicy yield, it's usually not because management is very generous. It's because something underneath is weakening. High yield can be a sign of a falling share price, deteriorating business fundamentals, assets losing value, payouts that aren't sustainable, rising debt costs squeezing margins, or even a rights issue quietly forming on the horizon. But many investors buy anyway because it looks cheap, or more yield must be better, right? That's exactly how people get trapped. Here's how to avoid this error. Ask the 4 reality check questions before buying any high-yield counter. Pause and ask, is the dividend actually supported by real cash flow? Is NAV stable, or dropping like hints of deeper problems? Is the business growing or slowly shrinking? Did the yield increase simply because the price collapsed? If you cannot answer these confidently, the high yield is not a reward, it's a warning. And here's how to fix it. Prioritize safety over seduction. Shift your mindset from yield maximizing to risk minimizing, because a steady 4 to 5% from strong banks or diversified dividend ETFs often beats a shaky 9 to 10% REIT that cuts DPU, drops in price, and stresses you out every results season. Long-term passive income is not built by chasing the highest yields. It's built by choosing the most durable ones. Chapter 3. The Silent Dividend Killer. There's a reason currency risk is called silent. It doesn't shout. It doesn't move dramatically every day. But slowly, quietly, it can eat into your dividend returns without you even noticing. Many Singapore investors look at a USD or HKD investment and think, "Wow, 6% yield. Not bad." But here's the part most people forget. If the USD weakens 5% against SGD, your real yield is no longer 6%. It's 1%. And sometimes even less. That's how many well-meaning investors end up with nice-looking dividends on paper, but shrinking income in reality. Yet without realizing it, Singaporeans keep loading their portfolios with USD-denominated REITs, Hong Kong dividend counters, overseas ETFs, all without tracking how FX quietly drags returns down. So, how do you avoid this error? Use the 80-20 rule. Keep things simple and safe. 80% of your income-generating assets in SGD, 20% abroad for diversification and growth. This isn't about avoiding overseas investments. It's about protecting the part of your portfolio meant to pay for kopi, groceries, and your future retirement lifestyle. And if your foreign exposure has crept too high, here's how to fix it. Shift gradually into solid SGD REITs. Strengthen stability with SGX dividend ETFs, build a reliable ladder of SSBs or T-bills, and treat foreign assets as growth opportunities, not your main source of income. Because here's the truth. Your bills are in SGD, your food is in SGD, your retirement is in SGD, so the income you rely on should be in SGD too. Chapter 4. Holding REITs without checking their debt costs. Of all the mistakes REIT investors make, this one is the most expensive because it stays hidden until it's too late. Most people focus on yield, occupancy, property type, but they overlook the single biggest risk in today's environment: the cost of debt. When refinancing costs rise faster than rental income, a REIT quietly starts losing ground. DPU shrinks, NAV softens, gearing climbs, interest coverage tightens. And one day, out of nowhere, a rights issue appears. This doesn't happen overnight. It creeps in quarter by quarter until the unit price finally shows the damage. So, how do you avoid this error? Watch the 3 numbers that matter. Every results season, check that. 1. Gearing below 40%. 2. Interest coverage above 3 times. And lastly, a high percentage of debt fixed. These 3 numbers reveal most of the REIT's true financial strength. And here's how to fix it. Act before stress becomes pain. If a REIT weakens across 2 to 3 quarters, trim your exposure, shift to stronger REITs, reinforce stability with banks and dividend ETFs, and build an SSB or bond buffer for predictable income. Because in REIT investing, the rule is simple. Hope doesn't protect your dividends. Math does. Chapter 5. Focusing only on dividend yield instead of total return. This final error is the most common and the most costly because it feels harmless. Many Singapore investors look at a stock and think, as long as the dividend high, can already. But dividends alone don't build long-term wealth. Total return does. A stock yielding 10% may look fantastic, until you realize the share price has been falling 4 to 5% every year. Meanwhile, a solid bank or ETF paying 4 to 5% with steady growth on top can quietly outperform everything else over a decade. This is how many income investors accidentally trap themselves in high-yield counters that look rewarding, but slowly erode capital, confidence, and future retirement income. So, how do you avoid this error? Look beyond the yield number. Ask yourself, is this company or REIT growing its value over time? Are earnings stable? Are assets improving or deteriorating? Is management disciplined with debt and capital? If the answer is no, the high yield is simply compensation for higher risk, not a bonus. And to fix it, balance income with growth. Build a portfolio with two strong pillars: income generators, REITs, banks, dividend ETFs, SSB ladder; value growers, defensive retailers, telco or infrastructure, broad market ETFs. This mix gives you predictable cash flow, gradual capital appreciation, and long-term resilience. Because true passive income isn't just about collecting dividends today, it's about protecting your future income tomorrow. Final thoughts. Build income. The cash flow rich way. At the end of the day, the Singapore income investor who thrives is not the one chasing the highest yield, but the one who builds the strongest foundation. The investors who succeed long-term focus on designing cash flow with intention, choosing quality over temptation, respecting currency risk before it hurts, watching REIT debt costs like a hawk, and prioritizing total return, not just today's dividend. These are the principles that turn a portfolio from just investing into true financial confidence. If this video helped you uncover mistakes you didn't even realize you were making, like this video so more Singaporeans can learn to build safe, steady passive income. And subscribe to Wealth for You, where we help you build a cash flow rich retirement you don't need a holiday from. Before you go, I'd love to hear from you. Which mistake surprised you the most? And what will you fix first? Share your thoughts in the comments below.